A very good evening to our audience here. Thank you very much for spending your evening here with us. My name is Wee Hua, and I'm your host for today's episode of Ask Me Anything webinar series. Right, let's find out how should I invest at my age. Right, for secure financial future, it is important to start saving as early as possible. Right, so how can we effectively plan our finances, especially when we are going through different phases? How do we optimize our allocation of our funds, be it in savings or in investment, right? So I'm quite sure everyone has some burning questions, right? May I request you to plan your questions because our session must end in 1 hour's time, including Q&A, right? And for the audience, we are actually live on Zoom and Facebook. All right, before I introduce my guests tonight, I must assure you tonight that there will be no selling during webinar. All right, it's completely educational. So if you are watching us, please share with your friends whom you think you might benefit from this fireside chat, where you can ask them about any questions, be it investing at your age, life, to our very own financial specialists. Okay, so I'm very honored to introduce 3 of our financial specialists. All right, let us hear from them on how you should be investing at your age, right? First, we have Claudia, Financial Service Director. We have Elin, Financial Advisory Consultant. We have Thomas, Business Development Investment Solution. Right, let's hear it from them. Without further ado, let's start off with Claudia. All right, hi Claudia. Would you like to share something about yourself with the audience? Right, let them know you better.
Oh, hi, good evening, everyone. Thank you for joining today's session, and thanks, Wee Hua, for introducing me. Yes, I am in this financial industry for quite some time. I personally experienced a few major investment cycles, all the way from 1997 Asian financial crisis, 2007 market downturn, and now investment market with COVID and high inflation. So hopefully my sharing today can give all of you some ideas about choosing suitable investment product that matches your risk preference and also investment objectives at different stages of life. Thank you.
Right, thank you, Claudia, for introduction. Well, indeed, a long experience since started from AFC to GF Global Financial Turmoil. All right. We'll listen more from you later. Next, can we have Elin? Elin, is there anything that you'd like to share with our audience here today?
Okay, good evening, everyone. Thanks for taking time out to actually attend this seminar. I'm sure that most of you are here because you have a keen interest in starting your investment so you can achieve your desired lifestyle goal, be it for yourself or your family. Just like yourself, I was in this phase some years back, and I'm also thinking how I can get started on this investment journey. So personally, for me, I started my personal investment around 3 years ago. And then I have met like a lot of investment roadblocks. So have seen the bright side, of investment and also the downside. So thanks to all this experience, I actually learned some strategy to employ, and also not in just bad times, but also in good times. So my investment actually picked up further when I found a mentor who actually guide me and ensure that I invest due diligently and with discipline. So I also wanted to do the same thing for my clients and friends. So I completed my CHSC to broaden my understanding of financial offering and ensure that I'm kept up to date with the market happening. So that's more for work. So for myself, I actually enjoy the workout, and actually I like to sing.
All right.
That's for me.
All right, thank you, Elaine. Maybe you would like to do the singing later. All right, thank you, Elaine, for the introduction. Next, can we have Thomas? Let's welcome Thomas. Thomas, is there anything you'd like to share about yourself with the audience?
Thank you, Wee Hua, for the kind introduction. And of course, also thank you everyone for joining us tonight. Myself, as Wee Hua mentioned, I handle business development for our newly merged investment solutions department within Phillip Securities. So if you are interested in knowing about discretionary funds, portfolio management, or you just want to be kept up to date on the markets, just we can always meet up for coffee and we can discuss about the markets.
All right, thank you, Thomas. Wow, that's indeed quite a big portfolio that you're holding. from robo to savings account to unit trust, quite a fair bit of products and solutions that you'll be discussing this evening. Yeah. All right. All right. That's for the introduction for my special guest tonight. So at this juncture, let us get our audience tuning in to do a little poll, right? So I will flash and read out the poll. If you're on Facebook, you can comment in the chat box on your answer. If you're on Zoom, just click your answer. We shall probably wait a minute or two to get a little know about you, about the audience today. All right. So which life stages that I am at right now? So we have tertiary students, NS men, just started working, married, with kid, without kids, golden age. Okay. We can see some numbers coming in. Oh, okay. That's an interesting poll figures here. We have quite a number from the golden age. We also have people start working and some married with kids, with or without kids. All right, so interesting. That's about 71% in the golden stage. All right. That's very interesting. Yeah. Okay, Ken. Just okay. Okay, thank you for the poll. Okay. Okay. Next, we probably move on to a slide. All right. That my friend shared with me. It's very interesting to know that. Right. Do we want to grow our income, or do you want to have so-called a growth or an income? All right, and of course, we wanted to have a combination of both, right? So of course, in a successful investment portfolio, we should reflect on our unique needs, okay, whether our appropriate risk level on where you should be investing your investing journey, all right? Of course, we talk about for retirement. In retirement, we probably want to have a more consistent and attractive income stream versus a person who just started work. Right, they can have a very high risk tolerance. They can actually have a very long investing runway. All right. So this is something that we need to know. So do I want to have income, or do I want to have growth? Of course, yes, I know. All right. Most of us want to have both. Okay. Yeah. So let us start with our first very questions. All right. Basically, this is a quick question. Like, I just started working. So how should I start investing? All right. Can we have Claudia to probably answer these questions?
All right. Okay. I believe that when someone asks this question, he or she understand and agree that making their money work harder is very important. Instead of just saving money in a bank, which will not be enough to beat inflation, taking some risk and going for opportunity with better return is certainly more meaningful. So depending on an individual lifestyle, if you have savings of $500 a month since you just started working, you can choose to go for regular investment in unit trusts where you can choose the investment sector. Example, technology, pharmaceutical, or green energy type of investment. You can choose to fully invest into equity or mixed asset fund, which are lower risk. I personally encourage young working adults to start with unit trust investment unless you have sufficient time to analyze the market and understand the company before investing into it. Especially those who are inexperienced, you need to invest in the market to understand how the investment works. It will be much more meaningful than just sit down and listen. How about you, Elin?
Yeah, sorry. Yeah, okay. Basically, whenever I get this question from my client, I will always ask them this question back instead. Like, what do you need the money for? So their answer will actually help them to determine whether do they want to put their money into investment product with potential to produce income, creating passive income, or prefer to concentrate on growing their investment value. Investing is a long-term process. So before you begin, it's important to understand that the first part of adopting a successful long-term investment strategy is to have a disciplined saving habit. So regardless of whether you are saving or investing for your retirement, new house, or just travel around the world, for 6 months, you actually need to develop a good saving habits. So regular contribution to saving or investment account are the most productive. So once the objective is clear, it will be very easy to start. So for starter, I share the same view as Claudia. You may invest into unit trust via poems, or you can invest through an investment linked product. So start disciplined investing habit and make regular monthly contribution, no matter how small it is. So one last thing I would like to emphasize that is, yes, the tough part is actually invest regularly in the disciplined fashion. But the toughest part for people who are actually looking to invest is always the first buy-in. People tend to overthink and over worry, lead to procrastination. So once like their ideal timing for investment to start investing right is missed, they will rethink their plans and know about start investing. So keep this in mind and just take the first plunge. So that's all from me. How about you, Thomas?
I think, okay, apart from the points mentioned by Elin and Claudia, my personal advice is to evaluate one's time availability versus the quality of life that you want to achieve. Because I think many of you are seasoned investors here today. You will also know that, to maintain your own investment portfolio, it requires a lot of time and effort to study the markets. You need to fundamentals and technical analysis aside. I think we know that today's financial markets are heavily affected by macro and geopolitical news, right? Any small event, like for example, the Russia-Ukraine tensions has a chain effect on various sectors across the world. And then, with all this volatility, you still need the time to rebalance your portfolio. So I've met many clients who are experienced investors themselves, but they're not able to find the time to invest without sacrificing their family time or personal rest time after working hours. So I also have clients, I think many of you might be able to relate when you reach home after work, you need to do the household chores, you need to teach your kids homework, or you want to spend time with your girlfriend or your wife or your husbands, right? So as an investor, I think to reach your investment goal, you need to evaluate your time availability versus the quality of life that you desire. So choosing the right investment products is very important. So if you are not familiar with the type of products to choose, my personal belief is that you should engage professionals such as Elin or Claudia to assist you in analyzing your current portfolio and what are your goals and how can you reach there. Alternatively, I think there are a lot of personal portfolio management services out there, or even robo products that can help you to reduce the pressure of maintaining your own portfolio. So I think these are things that investors can definitely consider.
All right, thank you, Thomas. I guess after hearing Claudia, Elin, and Thomas, we realized that we need to have somebody to handhold, especially for new investors, to take a baby step towards investing. As what Elin mentioned, right, the first step is always the most difficult. All right. Okay. Next, do we have another? The next question will be, what are the factors should I look out for? All right. Can we have Elin to answer this question?
Okay. Maybe I will share with you guys what I usually do. So I always think that history always repeats itself, and how rich people become rich and maintain their wealth never change. So a very good example would be many retail customers falling into the trap for going for quick gains, such as crypto or meme stock. So thinking that that's the path to becoming rich. So they see their dreams becoming a millionaire gone within a very short time. So the way, right, I used to grow my wealth is a simple HOP. HOP. So H stands for homework, which means that whenever I do homework for my client, I'm also doing it at the same time. And then understanding what you're investing in, as well as the market trend. So O, right, is actually stand for option, whereby I diversify my portfolio with other investment instruments. So there's an old saying, don't put all your eggs in one basket. So look out for, what other investment instruments that you can use, or what other sector you can invest in. So lastly, P stands for partnership. The path to wealth, right, is always having a trustworthy partner. So the reason that, why is because, it's always good to have a regular portfolio review of your investment with a financial advisor to understand your portfolio performance. Is it expected? What are the impacts with the current market happening? And are there any other strategy they need to employ? So this is from me. What about you, Thomas?
I think on my end, investors should actually identify. I think, okay, my point of view is more relatable for the traders today. So you should identify when you're buying out of FOMO. So FOMO, what we usually call the fear of missing out. Investors need to identify when they are buying out of FOMO. They need to exercise discipline in their trades and ensure that they have the right information flow. So why I say that? Because in the past 2 years, I think with the new trends of investing, I think a lot of, especially with COVID, I think the younger generation now have a lot of disposable income to invest. And I've seen a lot of clients and even friends from the circle around me, they take investment advice from Wall Street Bets. So for those of you who don't know what Wall Street Bets is actually a Reddit blog where they will post out, for example, short squeeze events. Like for example, if you're familiar, there's the GameStop, there's the AMC short squeeze. So after the first short squeeze happened for GameStop, I think everyone was so sold by the idea that you can have easy profits just by participating in this type of trades. But usually what they don't realize is that in such situations, these prices, they fluctuate by the minute. In the most recent short squeeze for Bed Bath & Beyond, the price went from $5 to $25. And by the time the information flow reaches the social media and everyone knows about it, it is usually too late. So I know of a lot of friends who went in almost at the peak of the rally and they leveraged. So by the time they tried to close their position, they already made a huge loss. So if investors ever find yourself, or traders, if ever find yourself in such a situation, you should just exercise your self-discipline, cut your losses. You need to ascertain if the information that you're getting is from a credible source and not just a social media influencer. You have to do your proper due diligence. So that is how I feel. What about you, Claudia?
Actually, I fully agree with you and I fully agree with Elaine. So for myself personally, other than risks that I mentioned earlier, high risk, medium risk, or low risk, all types of investment involve some expenses also. Such expenses include things like sales charge, admin fee, exit fee, or even switching fees. So depending on the product or platform they choose, for everyone who is considering buying anything, any type of investment, do look at the overall fees and understand the total expenses before you start investing. So this is the same as buying a car or a house. We must consider the tax, maintenance fee, for example, buyer-seller stamp duty, rental tax, root tax, etc., etc. And the second factor will be time the market or time in the market. We always heard people say, buy low, sell high. Sounds very easy, but no one can actually predict the investment market accurately. So in order to harvest the return, stay invested for a period of time is necessary. At this age, assuming you are 30s, you can take high risk since your investment horizon is very long. But do take note, investing today and get 500% return by the next day may not happen in investment market. It may happen in casino. You can try that. So especially during this period where investment market is very volatile, investing now may get you 30 to 50% return in a couple of years' time. But there are investors out there who are losing 30 to 50% within weeks. So you need to be careful and seek your, proper advice from your advisor and invest diligently and carefully.
All right. Thank you, Claudia, Thomas, and Elaine. All right. From what I hear from all three of you, seems that diligently doing homework is a way to go. All right. Of course, for those audience here with children, all right, taking PSLE, taking O level, yeah. Now you know that doing homework very important as well. Yeah. So likewise, when it comes to investing, diligent doing a homework is a way to know what you will be investing in. All right. Before I move on to the next questions, let's do another poll. I'll flash and read out the poll. So likewise, when you're on Facebook, you can comment in the chat. on your answer, as well as on Zoom, just click the answer. We probably wait probably a minute or two. All right. So what type of investment are you in or invested in right now? So we have stocks and shares, we have unit trusts. I mean, some people call it mutual funds. We got bonds. I mean, of course, another word people call it fixed income, and REITs. Of course, we know crypto, fixed deposit, all right, or you can call it term deposit in US, physical property, all right, and of course, cash, right? I don't invest. Okay. Yep. Can. So yeah, you can actually take on the investment that you have right now, so that we can actually have proper poll that to see what you are invested in. Okay, interesting. We have quite a number of participants here. In fact, majority of it invested in stocks and shares. Quite a number, 50% also in unit trust, some in fixed deposit, some properties. All right. Crypto is the lowest. Okay. Of course, that crypto is a lot of speculative involvement inside crypto. All right. Ken, thank you very much for the poll. Okay. Next, next question that we have is that this is very common. Okay. I have committed to a BTO, all right, and do I have enough money to save or to invest? So it's a dilemma questions here. Any one of our speakers can take these questions.
Maybe I take this question.
Thank you,
Okay.
Claudia.
This is indeed it's a common question, and very often I get this from my younger clients. It's always in their mind that they would like to pay off their house as soon as possible, and they don't mind spending more money on renovation to build their home sweet home. Meaning, with this commitment, there is no more money left for savings or investment. So to answer this question, I will usually ask my client two questions. Do you know that all of us need 3 to 6 months of emergency fund for raining days? And have you already saved up your emergency fund? So the reason why I highlight these 2 points to my client is to encourage them to do their math and plan within their means. So when you understand this part, you will not overly commit to your spending, and you will certainly have some savings. So depending on the amount you have, you can still go for some low risk investment or capital preservation product. How about you, Elin?
Okay, like for me, I will probably talk more about the risk part. You know, everybody knows that investment will involve certain risks. So your risk tolerance need to correspond to the rate of return that you are looking at. So if you are looking at a high rate of return, naturally you expect a higher amount of risk. So, and also other factors such as time horizon to consider. So if you are looking at a long time horizon for your investment, the risk will be reduced. So if you're looking for shorter term investments, such as buying house, you probably want to take on lesser risk, as what Claudia said, and more liquidity in your investment. So to provide more liquidity for emergency, you actually need to have more cash reserve in money market fund or traditional saving account. So that's for me.
All right. Thank you, Claudia and Elin. Okay. Probably move on to the next questions here. All right. The next question is that with my limited budget, what can I do? All right. This is also very common questions. Can we have Thomas on this answer?
I think for my end, right, rather than what can you do, maybe I can share on what not to do, because I see many new investors these days, because they think, oh, I have a small capital, I only have $1,000 or I only have $5,000. Then they engage in day trading, scalping, and they use leverage. They go onto the Forex market, they go 1:10, you know, go crypto market, all because they want to multiply their small capital. And personally, I myself have gone through that phase as well, many years ago. And what I've learned over the years is that there's just too much noise in the market. When you are scalping, when you're day trading, you are looking at very short time frames on your technical charts. And you'll come to realize that all these indicators, they are very inaccurate. You you would think that, oh, I will have, 4 of the indicators coincide. That's multiple perspectives telling me that, yes, I should go into this trade. But after you go into the trade, how come I lose money? How come it go opposite? Because in the short term, I think seasoned investors will all know, in the short run, the market is run by emotions. So my best advice for investors is to exercise proper risk management. Don't be greedy for high returns. Because in a bull market, right, using the 2020 COVID recovery phase as an example, anyone, really, anyone can pick a growth stock and they will average at least 15% returns in today's day and age. So like I mentioned earlier, using the recovery phase in 2020, many of my clients achieve at least 40% returns on their personal portfolio. But what they do not usually realize is that they have too much concentration risk in their portfolios. For example, I've seen some clients go 100% into Tesla. Or I've seen clients, have 60% of their portfolio in, the FANG stocks alone, or, in tech sector, EV sector, that's it. And I mean, while this might bring you high returns in the bull market, especially when the liquidity, in the market flows into all those various sectors, you as an investor, you will suffer in volatile periods, such as, 2021, or even this year when, with the rising yield environment, the market has been very volatile. So I believe many investors have been suffering, especially all those clients that shared with me that they got 40 to 60% in returns in 2020. This year, all of them are suffering. And right now they are stuck with their counters because they can only ride through it. So because they didn't cut loss at that point of time. So as much as bear markets that happen only once every few years, poor risk management and the lack of diversification can cause you to lose all your gains, all your profits in just one massive drawdown. In a bear market, in a recession, especially if you have a full tech portfolio, it is very normal for your portfolio to have a 60% drawdown within a short period. It will happen, especially if you're leveraging. The chances of you, hitting your margin call is very high. So if you have a limited budget, and if you should be patient, you should look at like Claudia mentioned earlier, time in the markets, right? So you can consider robo products because they generally have lower management fees and they also have very low minimum investment amount. Usually robo products these days out in the market, they start at $300 or $500. I mean, using our own robo as an example, which I know very well, it's only $300. And I know our other robo products out in the market all begin around that range. So you definitely can consider something like that if you want to start with a limited budget. So what do you think, Elin?
Okay, from me, right, I will just share a short one. Like if you want to invest with very limited budget, right, you may consider investment-linked product, which is also known as ILP. So why is it so? Just 4 pointers that I will share. First is affordable entry. Starting from 200 a month, you are able to start investing. Second is the jumpstart bonus. Some call it the startup bonus. So some ILP in the market also provide a jumpstart multiplier for you to amplify your returns for your investment. So third, right, is actually access to special funds. So no AI funds are typically inaccessible unless you have a large amount of capital. So however, it's now within your reach as those funds are available via ILP platform. So last but not least, which is the most important thing, is actually dollar cost average. So one thing ILP is you will set up gyro, which will automatically help you to stay invested no matter what. There's no emotional involved like what Thomas mentioned. So therefore, it will also help you to stay invested and also help you with dollar cost averaging. So what about you, Claudia? Any advice?
Yeah, sorry, my mic was mute. Okay. Now, earlier I mentioned unit trust is suitable for young working adult and especially for the inexperienced investor. If you are now at your middle age, maybe 45 years old roughly, and have some investment experience, but with a relatively tight budget, you can consider a lump sum investment into direct stock market and shares. And I know which might be more volatile, but lump sum investment in unit trust might be also suitable. So it really, really depends on your risk. And there are thousands of unit trusts available in the market. You can certainly find funds which can fit your risk appetite. And as for direct stock and share, do take note that you need to monitor the performance yourself. And since there is no fund manager helping to rebalance your investment portfolio, alternatively, you can consider engaging our fund manager to invest on your behalf. Both ways are actually doable. Thank you.
All right. Thank you, Elaine, Claudia, and Thomas. So we are talking about, right, we can actually start investing by small amount as well. So it's not necessary to be one lump sum, do a single time of investing. You can actually start building your retirement nest over time. That means on a monthly basis, right? So this is very interesting concept, like dollars cost averaging that Elaine mentioned. So maybe this concept, well, know why is it good in a way that in a high market, right, with the same amount invested, you are automatically getting lesser shares, right? Or likewise, the other way around. I mean, when the market went down, all right, with the same amount invested, you are actually getting more shares. So on the whole, the net amount of units or shares that you purchase are generally lower. So that's probably a good way to start an entry point here. All right. Okay, once again, thank you for answering the previous questions. All right, before we move on to the next questions, let's do another poll here. I will flash out the next poll. Likewise, if you're on Facebook, please comment in the chat. And of course, in the Zoom, you just click the answer. You probably wait about a minute, yeah? So, do you think CPF alone is enough for your retirement? So, well, simple, yes, no, not sure. Okay, let's see the poll results here. All right, we have a majority, 73% mentioned that it's insufficient to retire through CPF loan. We have about 14% say not sure. All right, okay. Of course, that we know that CPF, the intention of CPF alone is meant for retirement. But however, over the years since it was implemented, all right, things have changed. We use most of our CPF money to buy a property. We send our children to universities. All right, so more and more usage for CPF. Right, so the primary objective of the CPF is actually through retirement. Yeah, it's interesting to know that most people felt that CPF alone is not sufficient. All right, thank you for participating on the poll. Next, we have another question here. I am reaching my retirement. All right, so how should I invest? Let us hear it from the speaker. Can we have Claudia?
Yeah, personally, I think CPF money is not enough for retirement for me personally. Okay, now reaching retirement age means reaching the golden stage of our life. It's a period of great happiness, prosperity, and achievement. So usually when someone reaches this stage, he or she is likely to have gathered a sum of savings in a bank, or maybe has accumulated a sum in the investment market. But we can't leave the money and investment just like that. So as your investment horizon is shorter now compared to 20, 30 years ago, I would advise investors to reduce their investment exposure and focus more on products which are lower risk and can provide perpetual income. I personally encourage investors to maybe split their money. Half goes to retirement plan and invest the balance into dividend-based type of unit trust or stocks. So some of my clients who have been with me since day one, they have grown and they are now at their golden stage. We are in discussion to plan for at least the next 20 to 30 years so that they can have a constant stream of comfortable income for the rest of their life. For someone who intend to leave a legacy behind while focusing on investment and saving, they can also consider insurance policy which have investment component. Example, we call it variable universal life. You can control your investment in this kind of product. Okay, we can control investment within the policy and at the same time enjoy the coverage. So this is a two-in-one arrangement, which I think is equally good if you would like to achieve your financial objective through this manner. How about you, Elin? Or maybe Thomas, what do you think?
I think for myself, same as Elin, I'm not near that age yet. but I myself also feel that CPF will not be enough. Okay, but maybe what I can do is share what we have been advising and sharing with our clients. So I think like what Claudia mentioned, and also what I've shared earlier, the type of the quality of life that you want to achieve, right? I think that would decide the direction that your portfolio would go. And what we usually do is we draft up a dividend portfolio for our clients at their preferred risk level. Because as Claudia mentioned, I think as you have a shorter time horizon, what you want is to supplement your CPF payouts to increase the comfort of your retirement lifestyle. So depending on how extravagant you want your retirement lifestyle to be, then that's how you should structure your investment. But as to how to do this in detail, Claudia is definitely more professional than us at this area.
Yeah, I'm old enough to share this.
Experience is the right word.
Thank you for acknowledging that.
All right, thank you, your answer for Thomas as well as Claudia. I guess for retirement, it depends on how you define it. Some of us will say that, okay, I want to stay until the official retirement age. Currently, we are still at 62 to officially retire. All right, but of course that we can't take out all our CPF one lump sum, right? As we know that we can have other options like participate in the CPF life. All right, so by participating in CPF life, basically it forms parts of the supplement to the financial portfolio that you build along the way. So I would say yes, you need to have additional portfolio to complement on the CPF life. Yeah. Okay. Thank you both. Okay. Next, this is also a very interesting question. How much is sufficient? All right, can we, Elin?
Okay, I share the same thoughts as Thomas. It depends on what type of lifestyle you want when you retire. If you enjoy your current lifestyle, involve going out with your friends, buying gifts for your loved ones, or even traveling, I suggest you try to build a passive income using your monthly salary as a guideline. So for example, if you are drawing, like, 4K a month, you can plan towards like getting a passive income of 4K a month. So you can use many different type of source to build this passive. So such as CPF Life, part of it, I also think CPF not enough alone. So just CPF Life as a part of it. And then with retirement plan, dividends paying funds or stocks. So in summary, right, there's no right or wrong answer when it comes to how much is sufficient. But the question that you should be asking yourself is what type of retirement life do you want to have, after that? So that will actually help you out to plan easier. So how about you, Claudia?
Okay, the most qualified person to talk about this. Okay, come to this question. Everyone has a different answer or different amount to this question. So based on key finding 2021, okay, minimum income standard. So the study suggests that a single elderly person aged 65 years old and above without any chronic illness needs about $1,421 a month to meet the basic need. So while the study shows the amount, I guess we should firstly identify the type of lifestyle we want during retirement. So firstly, I always advise my clients to break down their current expenses and do the detailed calculation For example, are you still serving any loans? If yes, how much? Are you still paying your insurance premium? If yes, how much? How much do you need for food and holiday? And how much do you need if an illness strikes? So if you want to maintain your current lifestyle, you should at least add 2 to 3% yearly inflation into your current spending to derive the total amount. Secondly, your source of perpetual income, which you might have already prepared. So this includes your CPF money, your insurance coupon, dividend from unit trusts or stock and shares. So followed by some of the cash in the bank. So if it's still not enough and most of your money is still sitting in the bank doing nothing, I guess you should talk to your financial advisor to review your current portfolio and do the necessary investment to achieve your retirement goal. Because retirement is a happy moment. It shouldn't be something whereby it makes us worry too much. Thank you.
All right, thank you, Claudia, to share that on the experience and helping clients to do a calculation. Of course, that some of the participants here are still serving the loans, be it housing loans, be it any other form of loans. So this is something that we may have to address, right? On how do we manage our loans? How do we continue to pay our premiums? And at the same time, maintain a healthy body, right? This is very important. And of course, what are the expenses that we need to set aside, maybe for travel and stuff like that. So these all need to sit down and have a proper planning, right? To derive a reasonable lifestyle for our participants. All right. Is there anything to add on for Thomas? Yes, I know you are far away from retirement. Yeah.
Okay, maybe I can add on one small part, maybe from the fund management aspect. In terms of the monetary value, maybe if you're an investor, you can work back, because if you're looking at the dividend portfolio, you can calculate your targeted dividend yield on a quarterly basis. From there, you can work back on what you need. So that's how you know what's your starting capital required. But that, of course, that is only if you are only engaging in one portfolio. But if you are into various different asset classes, then my best advice, find Claudia.
All right, thank you, Thomas. Yeah, all right. Before we move on to the next to our Q&A session, all right, we welcome you to connect with PhillipCapital, with any of our financial specialists tonight. So all of them have something in common. They are very active in social media and always generous in sharing and broadcasting their value-added financial tips to their clients as well as followers. All right, and of course, they are growing their team. So we welcome like-minded individuals to join their growing teams. Yeah. Okay. We have some questions here. Oh yeah. Okay. And for those of you who enjoy today's webinar like this, would like to stay connected with us and then receive more updates, give us a like on our Facebook page. All right. It's facebook.com/Phillip Wealth Advisory. All right. In fact, this topic was actually chosen by you guys during our last webinar session. All right. So we actually gather some of the questions that I would like to pose. So we actually get the guest speaker to come and answer some of the questions that you brought on earlier. Okay. Now let us get to the Q&A session. All right. We have seen some of the questions posted earlier on. Okay, I have these questions here. It reads out from Kelly. All right, Kelly mentioned that read about 8 out of 10 fund managers are unable to outperform the market. Right, so is it better for us to do a DIY investing or investing in something like S&P 500, probably ETF, I presume? Anyone to take this answer? These questions, sorry.
Maybe I can take this one. Especially being from a fund management department, 8 out of 10 fund managers not able to outperform the market. Actually, I've seen this statistic somewhere too, but I think what you must understand is because actually each fund has its own investment mandate, which means to say they can only invest a certain way. So, which is why, like I mentioned earlier, information flow is very important. So in the case of DIY investing, right, your information flow will not be as good. And of course, fund managers, they are like athletes, the top athletes. Even the best athlete also will have, that 1 or 2 days where they're feeling a bit tired, where they're not performing as well. So it is at such moments where you need, financial professionals, advisors such as like Claudia, Elin, because they have the relationship with all these fund houses. They know which fund managers have expertise in which area. So that's when they are able to, advise you on which fund to go into in different market conditions. Especially just to share with you, recently I've been doing some market research as well. So in my sample size, I checked about 1,856 funds, and I looked at their year-to-date performance, and only 109 funds have a positive return year-to-date as of today. I just checked today only, and out of these 109 funds, there is a good amount that have both long and short strategies. So, like I mentioned earlier, it's very important to know what is their investment mandate. As an individual investor, you will not have that good information flow. As for S&P, yes, but I think there's also the market timing, and then you also must you won't be able to predict all these black swan events. So that's when the portfolio allocation as well as the risk management is very important. So when you have a professional advisor to assist you, that's when they're able to allocate maybe certain portion to fixed income when they know, for example, in the rising yield environment, they might reduce on the fixed income portion. Or when the banks are doing well, they reduce on the REITs. When the REITs are doing well, they will increase on the banks, things like this. So that is what I have to share on this question. Thank you, Kelly, for the question. Very good question.
All right, thank you, Thomas. I guess it's not so much on good so-called information or lack of information. In fact, nowadays we are flooded with too much information. All right, we have a famous YouTuber who give you investment tips. We have some fashionista give you stocks analysis and stuff like that. So there's so many information right now. So in the past you have only like certified investor, certified researcher or analyst will give you certain reports and stuff like that. Yeah. Now everybody is kind of an expert, even some YouTubers and stuff, right? So to select right advice, all right, it's good to actually engage the professionals to talk about your financial situations as well as your planning. Yeah. Thank you, Thomas, for the questions. Okay. We have another questions here. Regarding is now a good time to start investing, all right, as the market has been like pretty volatile, very bad lately, especially as at yesterday, all right, we are officially entering into a bear market in US. So who can anyone take these questions, like a good time to invest now?
Maybe I can take this question. So like earlier on, as what Claudia shared, never to time the market. So it's not about when to invest, it's about what to invest. No, even in good times, we also hear that people lose money. So it's actually like, I would say that this is actually a very dangerous time. So you do not use like amateur ways of investment. When people use bank, then we invest in DBS Bank stocks, for example. Then when people use Alibaba, we also buy Alibaba stocks. Then afterwards, everybody like Netflix. So we also buy Netflix. But this is the surest way to lose money, as can be seen in the past 2 years. Many companies such as Alibaba, like I mentioned earlier on, Alibaba, Netflix, they actually lose more than half of their value within a short period of time. So it's like a common saying, even in bull market, even monkey can pick a winning stock. So we definitely are not in the bull market. So while it's actually a best time to invest, right, but it's also a very dangerous time. So it's best, right, to look for a professional for advice to or do your homework well, really do your homework well. So instead of asking when to buy or is it a good time to buy, the best strategy, right, is to observe the past, what the rich investor have been doing. Just copy and paste. Thank you.
Right, thank you, Elin. Of course, when in good market, everyone is swimming in a pool, right? But of course, when a tide turns, all right, you can see, who is actually standing on the pool itself, right? So it's not easy to pick a right stocks, especially in a very volatile situation, right? Thank you, Elin, for the answer. Next, we have Yuan Tak questions. As long as a long-term income and growth investors approaching retirement, so in general, how much should we be allocating to CPF Life, Singapore REITs, Singapore banks, private annuity, and of course, quality tech stocks and cash? Claudia, would you mind taking these questions on allocation?
Well, firstly, I need to really understand because they give me a lot of breakdown. But generally, when someone approaching the retirement age, I would say that we firstly have to identify those investment product that I've just mentioned, the position of it, or rather the segment, where does it belongs to? Is it high risk, low risk, or medium risk? So the golden rules behind when someone reaches the retirement age, you have to reduce your risk from high risk to balance to low risk. So the golden rules for low risk is 80-20, meaning 80% low risk product, 20% equity or high risk product. So if you mention something like, if I don't heard it wrongly, something related to technology stock, then I would say that this is a very, personally, this is a high risk product for retirement investor, or retired investor. So you should definitely reduce it. Whereas things like Singapore bonds, these are safe haven. You should increase your portfolio in that area. So you need to have a proper mix in all these products in order to achieve, I would say, your desired return. Yeah.
All right.
Thomas, you want to add anything?
Yeah. Thomas, yeah.
Sorry, I was muted. Okay, I think for me, I come more from the portfolio allocation aspect. So you can use a few very commonly used strategies in your portfolio. So as REITs versus your banks, I think in terms of yield play, what we usually call the interest rate strategy, like I shared earlier, in a rising interest rate environment, the banks tend to do better, the REITs tend to suffer. And in a falling yield environment, we tend to favor the REITs more as well as a team. So this is one of a very common strategy that you can see. But if you're approaching retirement, I think your quality tech, your high risk counters should start to reduce, especially using the current market outlook as an example. I think your cash holdings should increase substantially. Using our own portfolios as an example, I think we started off the year holding about 20% cash, and now we are actually holding around about 50% to 60% cash in most of the portfolios that we are managing. But of course, if you want to find out more, I'm always available for a coffee.
All right, thank you, Thomas. Okay, we have another question from Poon Chang. Thank you for your questions. The question is CPF Life better than a retirement sum scheme, RSS? Anyone can take up this question? Okay, maybe I can answer this question, yeah. In fact, I'm doing research for my parent regarding the difference between a CPF Life and an RSS plan, all right? Basically, the main difference between CPF Life and RSS plan is that your monthly payout, it will stop when your retirement savings are depleted. So, or age 90 or earlier. So, retirement account, you will actually continue to take the monthly payout until it's depleted. Whereas a CPF Life offer a monthly payout of a smaller amount for life. All right, so these are the two main difference here. So ultimately, which is better, or RA is better, or CPF Life better? At the end of the day, we just have to make a decision whether do you want to leave some money behind, whether leave it to your children, or I can actually take care of this monthly expenses myself, or do I need to have a higher monthly drop? Yeah. So yeah, this is something that I spoke to my parent about it. So yeah, you can take this as a answer for that. Thank you for the questions. Okay, I guess and we have another question here. Yes, this is an interesting question. We talk about how do I recession-proof my portfolio? Or we all know that, as I mentioned, the market has been like dropped from the peak to now is probably more than 20% in the US, right? So a definition of a 20% drop constitute a recession. All right. So how do I protect my portfolio? Thomas, would you like to answer on that?
Oh, okay, definitely. Okay, I think first and foremost, sorry, I was muted. First and foremost, you need to structure a defensive portfolio. I think many investors know that, oh, they need a defensive portfolio, but what exactly is it, right? So using our team as an example, we usually begin with allocation in consumer staples. We must have an allocation in fixed income also. But that being said, where is the growth aspect? So for that, what we do is we strategically scale in to risk assets, such as your tech, your commodity sector. That's where you achieve growth. And also, we look for depressed situations. So what do we mean by depressed situations? Russia-Ukraine war, the regulatory crackdown in China. There are a lot of counters that are fundamentally strong, that are just, temporarily at a very low valuation. So I think earlier Elin mentioned Baba. Okay, this is not advice on the counter, but previously Baba had very strong fundamentals, very strong revenue stream, very strong business model. And in last year, I think their price dropped to double digit. I think a lot of investors in the Hong Kong, China market believe that, hey, that was the best time to enter. Right. So what we usually do is we combine our quantitative expertise along with all these fundamental matrices. Of course, as an investor, I think what you can do as well, you can explore things like inverse ETFs to hedge your portfolio against the downside volatility. So you can reduce your downside, or maybe in the best case scenario, you can achieve an absolute positive return. That is possible as well. But of course, that being said, whenever we look at inverse ETFs, there is that certain inverse ETFs are leveraged. So always be very careful when you leverage. For new investors, I always recommend you not to leverage. So that is what I have to share on this question.
All right. Thank you, Thomas. As we are approaching our 9 o'clock, okay, we'll probably take on the last questions. Okay, this question here talks about, all right, okay, our inflation rate has probably 5% right now. In fact, I had my chicken rice this afternoon. It cost me like $8. So gone were the days that you have $3, $4 chicken rice. All right. So yes, 5% inflation currently, and well, people are expecting the inflation to go even higher. So is there any amount, is there any investment product that can give us a 5% return in this situation? Claudia, can you take the question?
Okay. So before COVID, our inflation used to be about 2% every year. It's now about 5%. It has actually shot up a lot. So to counter the inflation, everyone loves to have high return product, high return instrument. So if you are solely looking at dividend payout only, my question is, yes, there are products in the market which are paying more than 5% yearly dividend. But in investment world, the investment capital will fluctuate with the market movement. So meaning the investment product and the capital and the dividend payout are both not guaranteed. This is something that everyone need to take note. But if you are looking at the capital guarantee product with regular coupon, my answer is also yes. There are such products available in the market, and you can talk to your advisor to find out more about this product. Thank you.
All right, thank you, Claudia, for the answer. All right, so at this juncture, I also welcome comments on what kind of topics do you wish to hear in our next Ask Me Anything series. All right, your input is valuable to us, as we strongly believe in equipping our clients through education so that we can plan and make informed financial decisions. All right, so now let us have our speakers wrap up by giving some key takeaway from their own experience in investing at different stages of their life. All right, Elin, the takeaway.
Oh, okay. I don't exactly have two key points to take away, but I will just share earlier on again, the strategy that I've been using, which is HOP, HOP, which worked well for me for years already. So as I say, H stands for homework, so do your homework before investing. Then O stands for option, diversify your portfolio by using different investment instruments or into different sectors. P stands for partnership, finding a trust advisor, to get your portfolio reviewed regularly. So that's all from me. Thank you.
All right, thank you, Elin. I like the homework. Okay, next, can we have Claudia?
All right. Okay. Like I mentioned, two key points. Okay. Always allow time for investment. Allow market to grow your money. Then the other one is always have 3 to 6 months emergency fund available. Be prepared for rainy day, and I believe you can better manage and plan for yourself and your family. Thomas?
I think for me, I will go back to the same point that I've shared a few times since the start of our session today. Your time availability versus the quality of life that you want to achieve. Because when you plan for your retirement, you plan for your future, you plan even for PTO, at any stage of your life, your investment journey, it should not compromise your quality of life. So you need the right information flow to find the right investment products to assist yourself in achieving that fair balance. So that's my key takeaway.
Thank you, Thomas. All right, we have come to an end of the session. All right, I would like to thank our three remarkable speakers for their sharing, and a big thank you to you. All right, to everyone who has stayed with us thus far. Right, do join us for our upcoming Ask Me Anything episode. All right, so thank you once again. See you and have a good night. Rest. All right, bye bye.